Okay, perfect. Let's do following technicals. Here, if we look at 1996, right here, I think the price was around $5 a share. So if you invested in 1996, so it's 20 years ago, and at this moment, okay, 115, so it means that you increase it 23 times the price of the shares. Okay, so if you invested $5,000, it would be 115,000. If you invested $50,000, you will have $1.1 million, right? If you invested, let's say 100,000, right? So it would be about 2 million or something like that. So it's pretty good. But not only that, that your price increased. Remember how much in dividends companies paying this year? $2. 2.5%, it's okay, but in dollar value, $2. Now imagine that you paid here $5 in dividends or in a share, and now you're getting $2 as a dividend 20 years later. So it means that if you invested $5,000, you will get $2,000. If you invested $50,000, you would be getting now only in dividends $20,000. If you invested $100,000 in this particular time, now you will be getting $40,000 in dividends. And that's not in the consideration taking all this growth. You can invest this $40,000 and to do anything you like with them. That's the power of growth on dividends. That's how growth, like investors, with the growth of dividends, they make money. Because imagine now you need only 1 year, like 2 years, in order to pay off your investment which you made 20 years ago. Okay, I presume a similar situation happens with the property market, because when people buy the property and it's negative, and then 10 years later the price of the property went up, but also the rent went up. And now they are positively geared, even though they are paying same interest, same installments, but they're positively geared because the rent increased. So similar here, we have dividends increased. Okay, that's the interesting part. Now, what we can see here, it's reached 1, 2, okay, and now we can have it here. So, and based on that technical, so what can happen? Can it go lower? It can. Can it stop right here? It can, right? So it's really tough to say, but if it goes to lower, it goes maybe to 70-ish or even lower maybe, all right? So, and completely still drop. It might happen. But the interesting thing about this company, what I wanted to show you, is, look, that's the annual trend. How many times within last like 20 years it was like that RSI was below 20, below 30? Okay, 1, 2, 3 times. Okay, so after this time it was growth, after this time it was growth, after this time it was growth, and now correct. So here similar situation, 1, it's stochastic, 2, 3, 4, 5, and now 6 times. Similar situation with MACD. Yes, it can go to $65 or $70 based on technical analysis, but at the same time it can grow to 130%, like $130. So, and that's where we have to make a decision. Okay, are we going to be greedy a bit and try to get the best price possible, or we're buying and holding? Of course, it depends on your strategy, on your approach, and etc., etc., etc. But based on this analysis, okay, we know that it is pretty rare event when all these indicators, they align together, okay, in this low point. It happens only like in the last decade 5 times in total. Okay, it gives us certain reinsurance. Another thing which is I want to show, value line doesn't give us, I think it started from 2007 here, so we don't see these numbers. If you have access to Guru Focus, or you actually, I think I put Guru Focus, just look at these numbers, look at the how much company was making in this year, 2001, 2002, right? And here, and look at this drop, the price drop which company had. Just that would be your homework. Now, in this particular case, we definitely know that this period company was growing. Here, the sales went 0.2% down, but the earnings were still going up. And despite that, the share price went from $45 to $25. So lost more than 50% in their value, like I mean in the price. The question why? Yeah, correct, GFC. So people were panicking, people were feeling uncomfortable, but the company itself still were making money and still were growing. End of the world. So now we have from 115 to 70. It's actually much smaller, and we can see these pulls back. They were happening all the time here. You see. So it looks bigger now, but in reality, if you look at percentage terms, it's probably about the same. Okay, so it's not as bad as here. Okay, it's not as bad as here, and so that's why we can definitely see that it's oversold for this particular company. Now, I'm looking at this company for the last few weeks, and I'm trying to read as many reports as I can within my limited time. But the interesting what I've noticed that at the moment, a lot of not only government agencies but other companies, they're trying to get a kind of a pie of this company. You know, when somebody becomes really wealthy, you always will find somebody who is trying to sue them and get money out of them. Okay, so and that's what happens here. And I know that they agreed to pay about 750, I think if I'm correct, $750 million in some fines last year. So I presume that's affected. I don't know if they paid it straight away or they have certain installments in order to pay it, but I presume that could be one of the reasons why the earnings were affected, because we looked at the sales growth is continuing, but the earnings are flat. Maybe that was the reason. It's good to look in more details, kind of this type of issues, but that would be one of the reasons why it happened. Maybe they wrote off more goodwill also. We look at this particular case, but I still, despite that huge fall, I am quite confident with this particular company, and I don't see it's falling more and more and more. Okay. All right, so let's have a look at closer look. So that's starting from December last year. It has a gap here, and after the gap, we can see that this is moves, right? So what we can see here, what kind of trend is that? Is it uptrend, downtrend, sideways trend? Any figure? It's kind of triangle, it's called. So because we can see that this high point, and we have the next high point is lower than the previous one, and this one is lower than the previous one. So we can see it's kind of downtrend on the top, and then we see uptrend at the bottom. So, and it's kind of getting, some people call it flag or whatever. If you put the handle here, it becomes like a flag, right? And that's what we can see, right? So it's kind of narrowing down. Here was a small gap, and now for the last 4 days it's flat. It's holding this level. So the next probably level of support, because it's broke this level, it's a bit under it now. So the next would be about $4 here. And if it breaks through, the next one would be about $73. Okay, it might reach there. If it breaks, that could be the next point, which is about 70. So that's technically, if we look at this particular company, we don't expect any news in the next 2.5 months until next earnings, right? So what we can see here from indicators point of view, we can see that MACD is low, stochastic is oversold, RSI shows our first turn. These two, they're not showing us yet. Okay, we can see that it's still going down. Here it's still going down. Okay, it didn't turn around. So that's why it's quite easily can a bit stay on this level or maybe going down a bit before the indicators will show us. Okay, so just if you decide to enter this position, so try to maybe monitor it for a couple of days, and then we'll see if it's going to like be good position to enter. Okay, so calculate it yourself. Looks like a base on the fourth last candle. Yeah, it looks like, it's definitely looks like. So that's why make sure that you are going to like monitor it. And if you see uptick, because there is no uptick here, we can see that also here, if you open here charts, like 30 minutes chart, you will see that the highest points, they're going lower, lower, and lower, and it holds the bottom part. So, and then probably today, even I won't be surprised that it's today, it's going to break through and move up or move lower down. And but remember again, we look at the market and we see that the market is a bit high right now, right? Even if it didn't achieve the resistance level, but still, if the market pulls back, so we can see that this company might pull back too. Okay, and it gives us even better opportunity to enter the position. But again, we are talking about here $1, like $2, okay, $3, something like that. So it's about 5%, but still 5% is pretty good if we buy the company 5% cheaper. Okay, is it clear about this particular technical analysis? Do you have any questions about that? Okay, perfect. Okay, so let's have a look at possible investment strategies. And I divided it to several strategies. So long term, then roll strategy, BR strategy, selling naked puts, and also at buy leap calls. And let's just go through them one by one. So, okay, if we go for just buy and hold strategy, we can buy it right now at $76. Now I think it's 76.33 or something like that. Or we can buy it and try to grab it a bit lower. So based on monthly tech analysis, it might go to nearly $70 or $65. And if you manage to buy it lower at that stage, it would be fantastic, right? But again, we can miss it if we become like greedy. It might never reach that level and might go up, okay? Now, and then we can wait and until, for example, lower level, which we calculated is $106, right? It can go above, but would say if our target is highest point of low scale, it's 106. So the possible waiting period, like 2 to 3 years, I believe, it's again my belief, it might achieve back to the 106 or more within the next 2 to 3 years. Now, it might go there much faster, but again, it has to be certain trigger for that. The reason why I believe that it might be below that within next year, because the projection for this particular year is flat, and I presume in order to trigger the growth, there has to be a certain event which triggers it. Okay, and if there is no event like that, the share price might be in this range, 70 to maybe 90 or $80, something like that. Okay. Also, you're getting altogether, if it happens like that, 40% of profit plus dividends. Okay. Another strategy, if you buy and sell. So again, if we look at these rolls, right? So we can see that the points based on that, it's about $81, $83. So we can buy it now and we can sell it here. So in this case, purchase price 73.76, 81.83 sell price. So it can give you 6 to 12% of profit. Now, how long does it take to get this money? Again, we look at technicals and we can see that was at the beginning of April. The highest point was somewhere after 3 weeks. Okay, here we see beginning of February. Here we can see about 3 weeks from there. So looking at that, we can assume that about 3 weeks takes to go up and then several weeks to go down. So if you buy and hold, you might buy it and you have to wait about 3 weeks in order to achieve those levels. Okay, that's if you buy and sell. Then BR strategy, we're going to look at this in details, and then buy liquid calls as well. Okay, let's have a look at selling covered calls. Now, again, the best way to buy it at support. So if we see that the share price moves a bit down more, so that's where we have to buy it a bit like shares. So not at current prices, but lower. In this particular case, I took as we're buying right now. But again, when you're doing it in your own account, definitely try to buy it lower. Okay, try to get it at a bargain price. So, but let's assume that's today, 23rd of March, and stock price is 70. Closing price of yesterday was 76.34, and I took three prices: 75, 76.50, and 77.50. Okay, now 75 is in the money, 76.5 it's at the money, and 77.5 it's out the money. So three options. Now this is conservative, this is neutral, and this is one aggressive one. Okay, so here we believe that share price will go up, and here we believe or afraid that share might go down even more. Let's have a look how much money we're getting. So when we're selling, we're getting the low scale. Yes, there are two prices, 241, 251. So we're getting 241. Okay, so that's what we're getting. But we're agreeing, we are buying shares at 76.34, and we're agreeing to sell it below at 75. So how much we're losing here? $1.36, right? But instantly we're getting $2.40. So is it a losing trade or not losing trade? Okay, it's a positive. Even if we sell at a low price, we're still making money. Now, but we have to take into consideration that the time value is much lower. So the time value in this particular case is 1.3% only gives us. So if you invest $100,000, it's about $1,340. But still, it's pretty good. It's much better than banks are giving us. And also, the thing is here that our break-even price is moving to 73.94 because, like, I mean, here already taken into consideration the commission. So that's why it's calculated this way. But if you deduct 75 minus $2.40, oh no, 76.34, right? That's what we purchased, minus 241. So we get about 390, yeah, so something like that, you know, so 73.94. That would be our break-even price. So it's like $3 below the current price, which is pretty good for us, $2.4 below current price. Okay, now if we decide to choose the neutral strategy, we get $1.50, so less. But if we sell it, we make some money because we buy it at 76.34, selling at 50 cents. So it's what, about 16 cents profit. So, and if exercised, so if the share price grew above 76.50, we get 2.1%. Okay, higher. And if it's not, so we get still 1.9%, which is pretty great, right? So it's already better than this price. So, and then the aggressive one. So when we are applying and we're happy to sell it $1 higher of current price, like $1.18 higher. So what we get only $1 premium. So it gives us 1.3% of time value. But if it grows up above that price, we get 2.8%. So and looked at our technical analysis, we can easily believe that it can go to $81. So it might be called out from us. So we might make this amount of money. But remember that each time when you're increasing your strike price, your break-even price is also moving up. So if in first case it was 73.94, in second case it was 74.85, and now it's 75.31. So it's only $1 below the current price. Okay, and that's why based on your own risk tolerance, you have to choose one or another or third strike price. Okay, also I looked at the June 23rd. Okay, you can look at the other strike duration. Okay, you can go for June 16th, or you can go even, there are two expiration dates earlier. Okay, you can sell it for 1 week only, for 2 weeks only. Okay, that's up to you. Okay, now guys, is it clear with covered calls? Okay, let's have a look puts. I look same duration. So instead of buying shares, so for instance, you don't want to buy shares, okay, or you want to buy them at a cheaper price. So again, the current price is 76.34, but what we do, we agreed to give an obligation to somebody that we are buying shares at 75, 76.50, and 77.50. So in the first case, if we promised somebody, that we're happy to buy the shares at $75, we're going to get right now 90 cents. Again, if you wait and the share price goes down, you will get more. Okay, so you can put a limit if you decide to do it, you can get more. So that's what you're getting, 90 cents. Now, 90 cents, if you take it, you don't pay any money now, you are getting money. But you will need to pay money if the share price stays below 75 after third Friday. So you have to be sure that you have this amount of money on your account when you do this transaction. Okay, and also you have to be happy to hold the shares for you. Okay, don't use this strategy unless you're happy to buy the shares. Now, in this case, you get 1.2%, but quite often brokers, they give you margin for that. And if you use margin, it's about 2.4% in that. So what do I mean by that? Imagine that you have $100,000, and if your broker allow you to use margin, so what happens? You purchase some company ABC, and you completely used all your cash. You have no cash at all, but you have margin. You can buy for $100,000 if you want to. Okay, so what you can do, you can just sell this put, knowing that you can use this margin if you need it. Because maybe you can sell ABC shares by that time if you decide to buy that share. So you have a buying opportunity. So in this particular case, you don't pay any margin commission for borrowing money, because if you just purchase the shares, you straight away will be paying that you borrowed $75,000 if you bought 1,000 shares. Okay. In this case, if you sell put, you don't pay a penny. You get money. Okay. This is a good thing. Okay. So if we look at 76.5 strike price, we get $1.49, and if we sell at 77.5 strike price, we get $1.96, so more. And we can see that our break even. So if we purchase eventually, if we purchase the share, so we can see that the cost of the share is much lower. So in first case, it would be 74.23. And second, it would be 75.14, and third one is 75.67. Sorry. So it's still about 50 cents less than current price, even more than 60. So about 60 cents less than current share price, which is pretty good for us. Okay, so we are buying shares at a cheaper price, and also you look at the return. So 2.5% if the share stays above strike price. So if the share price moves above $77.5, your income would be 2.5% or 30% annually. Okay. Now, is it clear about selling puts? All right. EN plus equal. Okay. So all right. So yeah. So if you don't understand the strategy, just practice on simulator. Maybe execute this strategy and see. So when you're selling put, and look at the module where I explained about puts. So you just, what you do here, you promise somebody that you are buying the shares at a certain price. So let's again look at 76.50. So what I'm doing here, if I sell put for 1 month with a strike price of 76.50, I promised that I will buy these shares at this price if that person decides to sell them to me. Okay, that person is going to sell them to me only if the share price below 76.50 on the third Friday. Before that, unlikely they're going to sell me. Even if the share price goes to 70, they're not going to sell it to me. They're going to do it only on the last moment, on the last day. They're going to sell me the shares at 76.50. Before that, I keep this promise for them. Okay. In this case, I have to have this amount of money on my account or margin, buy an opportunity to buy it. Okay. But like why that person, for the heck of whatever, going to give me money for that? And the reason why, because that person looks at this technical analysis, right, and thinks, oh my goodness, it can go to 65. So that's what he afraid of. So he decides, wait a second, I'm afraid that it's going to go to $65. Let's insure it. And he comes to me and say, Igor, will you buy it at 76.50? I said, yes, I will. I said, pay me money for that. And he's going to pay me $1.49 for that. So I'm insuring this person. Now, if the share price goes to 65, I oblige to give him $76 for his shares, and I have to buy his shares. So I'm carrying the risk here. Okay, so if the share price goes to 0, I still have to pay $76 for the share. So that's my risk. So the only reason why I'm going to sell a put like that and promise somebody, if I want to buy the share, if I'm happy to buy the share, if I'm not afraid that the share is going to go down. That's why we analyze fundamentally the share first, and then we decide to sell the put, okay, and buy. But if I do this deal, right, even if I buy the shares at 76.50, because it can go to $73, but I am not sure now if it's going or not, I'm getting $1.49 premium right now. So that's my profit instantly. So, and even if I buy shares at 70.50, so it would be the price of the share average would be less because I already got 149. So in this particular case, the share price would be $75.14. So it's below the current price, which is 76.32 now. Okay, and if the share price stays above 76.50, I just keep the money. I don't have to buy anything. Okay, is it clear now? Did I explain it or not? If not, asking the questions. Okay, fantastic. Okay, well, that's good, guys. Now, all right, and the third strategy I'm going to explain you, which called buying leap options. Now, I want to tell you before I explain the strategy that this strategy is highly profitable, but at the same time, it's highly risky. Okay, you can make, if you buy, for example, January, you can make 100% and 300% in both of them, but you can lose 100% of money. So that's why don't do it unless you're confident, okay, in that you understand totally what you're doing. It's first thing. Secondly, even though if you do this strategy, if you decide to do this strategy, never ever use the whole account for that. Okay, the maximum level of account which you can use for this particular strategy, it's 10%. Okay, so if you already sold like leap calls, bought leap calls for another company, so for leap calls, not more than 10%. So if you have 2 companies, so it means 5% each. If you have 3 companies, 3% each. So in total, this strategy has to be less than 10% of your account. Okay, because you can lose all the money which you invest here. So be careful of that. Okay, put pluses if you understand that. And now I am going to explain you how it works. Okay, so what I did here, I look at 2 strike dates. One is January 2018. But is the risk, Dory asking, but is the risk the premium of the current share price? The premium. We can lose all the premium, and I'll explain you now. Okay, so how it works out. just give you that you understand what is happening. Now, so when we buy options, we buy them for the long term. That's important to understand. Try to remember. If you sell something, sell it for a short period of time. Week, 2 weeks, 3 weeks, month. Don't sell longer than a month. Trying to sell like in a shorter period of time. In this case, you get because time value decay happens within a shorter period of time. 1 week, the fastest. Okay, 2 weeks, it's second fastest, and then like after 1 month, it's decay quite slow, and we're going to look at this. So when you're buying, you buy for long term. Okay, so it's like a rent. If you paying to hotel, right? So for 1 night, you're paying $300, right? If you're like getting the long-term lease, you might be paying like 600 a week, right? So it's like several times less. Similar story here. Okay, you have to understand it. Now if you buy it, I usually buy it. You can use different strike prices. There are different strategies, but at the moment, what we just for comparison, let's have a look. I don't know. You can choose the strike price you want. Is any preference for the strike price, or I pick? Okay, let's have a look. $75. Okay, Dory is chosen. Okay, $75. So both cases, 75 here and 75 here. So when we buy, we pay the higher level. We pay $5.40, and in this case, we will pay $8.05. So when we buy the right. We buy the right to buy the shares at $75. Okay, so at the moment, the share price is $76, and like in this moment, like 45 cents. So it means how much real time value, how much time value we're paying right now for this right. How much? Who can calculate it? We're paying $5.40, right? But $1.45 is the difference. So, okay, so what happens here? Dean, you calculate it correctly. It's the difference. It's a different $1.45 because if we buy it now, we buy it for $76.45, right? So, but we agreeing to buy it at 75. So it's like $1.45 below the current price. So it's a real time, the real value. So that's the real. That's why that person who's selling them now as that option, he's getting this premium, the difference, because there is a difference like that. Okay, because he promised us to sell his shares $1.45 below the current price. You understand that, right? But whatever we pay him on the top of that, that's the time premium. That's already we're paying him for this right. Okay, so in this case, we need $5.40 minus $1.45, right? And we get $3.95, like nearly $4. Okay, so $4 buys us a right to buy the shares at $75 for the next years. Now the question is, what happens if on January 18th, like here, the share price is below $75? What happens with our money? Are you going to buy shares at 75 if the share price is 70? Yeah, Dory is correct. So they're worthless. So whatever you put in this trade, it will be gone. That's why I never put all the money in this case, because who knows what can happen, right? So anything can happen in the stock market. And if you put all the money in this one trade and then the share price dip below 75, it means that you won't be able to do anything. Like, I mean, this money will be gone, and then you will have to put in another amount of money in your portfolio. So if you bought shares yes, your risk is high in the sense that it can go $10 down, but in this case, at least you can sit there, get dividends, and wait for another 1 year or 2 years, okay, until it recovers. With options, when you buy leap options, you don't have this luxury of time. Time works against you in this particular case. That's the worst case scenario. You understand that. Put pluses if you understood this. Okay. Now let's look at the upside. So imagine that we were right with our analysis, and the share price within this year, okay, until the expiration date, goes to $106. Assuming that it goes to $106. Can you tell me the minimum profit which we can get in dollar terms? What's the minimum profit we will get at this stage if the share price goes to $106? Use calculators to calculate it. Okay, Dirty 31, 3640. Okay, Ian, what's your? Okay, everyone is different, and nobody is right yet. Okay, guys, let's create like that. So first of all, what we can do, buy shares, like basically what we can do, we buy shares at 75 and sell it at 106. And Dory, you're completely correct. Okay, just a second. I'll try to do it. So 100. Can you see the whiteboard? Yeah. Okay, perfect. Minus 75. So we buy at 75. Would sell it at 70. So we get what Dory gave us, $31. So that would be the sale revenue. But what our investment was? How much money we put in the trade? 540, right? So 540, they're gone. Correct. So we are getting 2560. So that's our profit, net profit. Now, how do we calculate our percentage? What we do, we divide it by our investment, which is $5.40. No, $25 we divide by 540. That would be the interest rate, because we divide profit by our investment. So then multiply by 100, so we get 474%. Okay. Is it nice? Crazy, right? That's a fantastic trade. And that's why I gave you the warning before I explained this trade. Guys, it's highly profitable. It's highly profitable, but it's highly risky. Now, the risk is here that the share price doesn't go up, and instead of that, it goes down. Okay, you invest. So that's why you have to allocate only certain amount of your capital on that particular trade. Okay, do you understand? Because in this case, if you make this 474% profit, you need to make one profitable trade in order to cover 4 trades of losing if they lost 100%. Okay, so that's how it, like roughly. Do you understand that? Yeah. Now, how you can protect yourself in this particular case? In this case, what you can do, because our main risk here is the time, and we know that Walgreens, CVS Health, they said that this year they are going to be flat in earnings. So we can assume that based on our fundamental calculation, we get to this $106 level, but we might not get it this year. And we have only time, if we buy in this particular option, it's going to be only until this January, next January. So 8 months. It's still quite a big chunk of time, but still it's low. So what we can do, we can go for longer term. okay, and we can get $8.05. So now what's the difference here? So if we get 75 and we pay here $8.05, what's the difference here? $5.65, right? $5.65. So for and before we calculated it, that time value for 8 months, for next 8 months, we pay $4 for time value, correct? Dory was calculated $3.95, right? So it's like, because we pay $5.40, but the real value is $1.45. The time value was there $3.95, and here for the whole extra year, we are going to pay only $2.65 for this time value. Now the question is it worthwhile maybe to get 1 year extra or not? And that's where you consider, okay? So because by doing this, you increase your chance to wait for 1 year. It's much probability here becomes higher, okay, in this case. So if you get it, yeah, absolutely right. So the very difference here, here you can see 605 and 241 days. Okay, so that's how you can reduce your risk straight away, because you're increasing your own time. Now for that particular case. Now if you calculate probability, like your profitability in this case, yes, your profitability will be lower, because let's have, if the share price moves up to $106, how much money we're going to make here? Okay, so let's have a look at okay, so just new one. So here it's 106. Okay, same $31, but here we minus $8.05, right? We get $22.50 or $22.95, right? And then divided by $8.05. And how much we're getting here? Who calculated it? $22.95 divided by 805, 285%. It's nearly 100% less, but still very impressive, right? Okay, another thing. Let's go back to the same thing. Now, actually, you still can use the strategy and make money, but not wait for long term. Now, do you know that when the share price moves up, what happens with the price of the option? It's worth more. It goes up too. Okay, correct. Now, how much more? Do you know how much more it goes? No. Okay, I'll explain you. So there is a thing called delta. Delta changes every day. So and it shows you that particular option for this particular situation, how much it will go up if the share price will go up or down for $1. So in this case, we'll see what if this particular option, if the share price goes to $1, the option price will go how much? 57 cents. Do you see that? Okay, so I just delete it. Okay, so 57 cents. Now, in this particular case, what it means for us. Now, we looked with you based on technical analysis. Let's go back. That it might go to these levels. So $83. Can it? It can, right? So imagine the situation that you bought it now, and then it went to $83. Current price is $76.45. So if it goes, how much? $73, it would be like $83. 3 plus 3, $6.5. Now, if it goes $6.5 higher, now it means option premium. What's the option premium would be? How much in value option premium will go? Get calculator, guys, for you to just to understand how it works. Yeah, $3.7 extra. So the option will cost about $3.7 extra. So, and it might happen within the next 3 weeks. Okay. So in this case, what do you do there? Do you keep it? Do you wait it? You could sell it. Now, so what we can see, the current price is $5.40, and we can see the delta 0.572. So we assume that share price will go to $6.5 up. That's the share price. From we look at the moment it's 76. My goodness, my writing 76.50 to 83. Okay, so that's where we got the $6.5. Do you understand this, Dim? No, doesn't want to write droid triangle. Okay, so okay, guys, it doesn't want to. Okay, maybe delta like that. Okay, delta, it's D. Okay, equal 0.572. Okay, I'll show you where it is. So that's where we got it. 572. You see here. Okay, so what we do, we multiply 6.5 by 572, 0.572. So how much we get? We get 3.718, something like that. So it means that if the share price goes up by $6.5, the value of the option will go to 371 higher. So, and in this case, 3.71 plus the current share price, current option price 540. How much is going to be? Plus 540. 9.1. Okay. We can sell it at this moment. Okay. And how much, what's the percentage return here? So we get 3.718. We divide it by our investment, $5.4, which gives us, divided by 5.4, 68%. 68% of it. Try to again. It's Norway. I don't. You got 18. So 3.7 divided by 5.4. So it's 68% of profit. That's how you can. Yeah, thank you. So that's how you can use option strategies, buy and long call. Now, the good thing about it, if you're wrong and share price is not going to go, the time decay doesn't happen that fast there. Okay, and similar story you can calculate with $8. You can see that if we put $8 here, that would be increased 5.6 times. And you notice, look, the deeper in the money call, the higher delta. Okay, so the price actually, when it's going to go up, it's maybe moving not even, it might move not only $3.7, it might move $4.5, because each dollar which it goes up, the delta will increase. It will become bigger, bigger, and bigger. Okay, we can see that, for example, 75 and 70, it's already more than 10% here increase. Here, 10% increase. So it means then when the share price is going to be around $80, the delta for 75 would be about 67. Also, it would be higher. Guys, questions? I covered quite a lot today, so it was the longest probably masterclass we had ever. 2.5 hours. Oh no, 2 hours, right? I hope you explained you. Okay, fantastic. I'm glad you liked it. Okay, perfect. All the best, guys. Make money on the stock market. Be profitable. And pictures here. Okay. See you all, guys, in Redfern in a couple of weeks. And enjoy your time. All the best.